And we're live. Happy Friday, Jeff.
Happy Friday indeed. Yes, looking forward to this one, man. This is going to be a good weekend. The weather is awesome. We're allowed to get out into groups here where we are now. Not that it's advisable, but I think if people have been sort of isolating, then they're sort of allowing that. And but it's going to be great. I think we'll just get some takeout, go sit in the park, let the little one run around and burn off some steam. It's like summer weather this weekend, like borderline hot, which the last few weeks has been a bit dreary. So yeah, looking forward to spending some queue time outside this weekend.
Awesome. Yeah, us too. Austin's looking great right now. It's a little overcast, but man, it was super nice out on the morning walk today. So yeah,
must be getting hot there.
Yeah, it's always hot in Austin. It's just hot or hotter. It's
right.
There's no in between.
Might be getting Texas hot now.
Yes, yeah, it might be. By this afternoon, I think the humidity is going to kick up for sure. But we're not here to talk about the weather. One of my good friends says, we're not here to fuck spiders. I like that.
I mean, you could replace spiders with any random object there, and it would still be funny.
Yeah, and it's funnier that he's from Sydney. And no, I'm from Brisbane in Australia originally. Sydney's another city, in case the viewers don't know. But we've never heard of that expression. And the first time I said that, I thought that's great. Anyway, so today, FAQ Friday, we talk all about any question you have relating to buying and selling e-commerce FBA businesses. If you have any questions, drop them in the chat. If you have questions after we're done recording, drop them in the chat. We'll handle them next week. So we do take live questions. We have 5 that we've collected over the last week from our Facebook group, our Double Your Exit community, which is growing quite nicely, actually. So if you're looking to sell a business, go check that out. So we've got 2 from there. Jeff, I know you've collected a few questions as well. So let's jump right in.
Yeah, so sure. One of the questions that comes up all the time, but because it comes up all the time, I think we should keep the conversation going and keep answering it. Not that the answer changes at all, but it has to do with inventory. And in particular, like size of the business, if they're under $1 million, over $1 million, over 10 million, like how is inventory handled? Now, I think this question was a bit specific to say that, like, all right, say you find a buyer that says, I will buy your business for this price. Great, I like it. We agree to that price, but I've already bought, $250,000 of inventory and it's sitting on the shelf. Do I get paid for that on top of that as a separate, not a separate transaction, but you know what I mean, kind of a separate thing on its a standalone thing? Or is that just expected to be included in that purchase price? They buy everything all at once. So how is that typically handled that you see? Like I guess if you could talk about it in different tiers, I guess like under $1 million, over $1 million, and then maybe like a larger deal.
Yeah, for sure. And the good and the bad news about inventory is it's all negotiable, unfortunately. So even if you have a smaller deal, sub $1 million list price value, and you present the business plus inventory, it's still negotiable. So we deal specifically in 7- and 8-figure transactions, and we're searching for our first 9, as I keep saying. Jeff, no pressure. Let's get it today. So when you're dealing with professional business acquirers and you're dealing with strategic companies that are acquiring other businesses, there's an expectation that working capital is required, because if there's no working capital, there is no business. In an inventory-based business like e-commerce, FBA, you need the inventory to actually make the sales. So there is 2 ways to handle this. It can be plus, we can negotiate the deal plus inventory. It can be included. Typically in the ranges we're talking about, the common thing is for the inventory value to be included. Again, it's negotiated. So how we normally do this, and this might get a little bit technical, but the broad strokes of it is your average inventory over the trailing 12 months is what we typically include. And then anything above that, you'll get paid extra at close. If you're under that target, then you'll have to essentially take that value out of the deal. Now, this factors into deals. So yes, that does impact your multiple that you're selling for. So all of this is negotiable, but that's typically what we see with serious professional buyers that are looking at large deals. Maybe they've got $100 million on their balance sheet to acquire businesses with cash. These type of buyers, this is what they'll be looking for. The way we handle this is we don't use list prices. But what we do is when we come up with a value range for your business, we'll also work out what inventory should be included and make sure that your number that we're aiming for is in line with what the market will potentially pay for the business, so that we have wiggle room and we know where to negotiate. But the important thing is that you get your number that is needed to sell the business.
Right, your walk away number remains intact, and you're still happy with anything. Then it kind of doesn't matter what everything else does, right? So yeah. All right. Okay. So that's interesting. Yeah. When you talk about inventory in terms of working capital, it definitely makes a lot of sense. You know, like no widgets, no sales. So you're going to sell me the business, and I inherit all of this paperwork and all of these passwords. But if the products aren't there, then I've got nothing to sell, and I've got to go and order it and wait 3 months for it to wind up on my doorstep. So we're not necessarily, they need to take over the business in its current operating form. And then, as a business owner, you need 30 days of inventory or 40 days of inventory on a cycle to keep things moving the way they are. So, but sort of follow-up question to that is.
Well, actually, one more thing on that. One more thing.
Yeah.
So if your business, because a lot of business brokers do position a business for sale plus inventory. Even if that's the case, what I meant at the beginning was everything's negotiable. The buyer is going to factor that into their deal. So it's actually, they're thinking about this the same way. Whether they give you a multiple on cash flow plus inventory, the deal value is actually the same that they're going to be negotiating for. They'll have their targets in mind, and they're including inventory regardless. I just wanted to round that out.
Right. Now, there are certain times of a year where a business owner is going to need to order more stock. And we sort of saw this kind of like right around the time COVID was starting. A lot of people were sourcing from China. And as everybody in the space knows, China essentially shuts down for a month or so around sort of January, Chinese February, depending on, for Chinese New Year. So, they've dealt with stock for the peak holiday buying season, and then they've sort of anticipated a month-long shutdown for their factories. So there are certain times of year where they need to have extra inventory on hand. Is there a magic number or a proper ratio that investors like to see from sort of say their net profit to inventory? Like if they have $1 million business and they are at 30% and $300,000 in net profit every year, but they have $500,000 in inventory, how does that look, and how does an investor sort of see those ratios?
Yeah, so it's category specific. So depending on the category you're in is how this will be viewed. If you're in supplements, let's say, so nutritional supplements, and you have 500,000 against 300 of net profit, you're probably overstocked. Most of those businesses run really lean as far as quick inventory turns because they're sourcing locally, right? So it's a percentage of that net profit is how inventory is viewed. It's also time of year dependent. So if it is Chinese New Year, it's preparing for something like a COVID, or you're expecting big sales coming into Q4, the buyer will actually expect more inventory to be included. So it's what we normally look at is the 12-month trailing average. How much inventory do you have on average at cost, at landed cost, against your net profit?
Got it. And so there really isn't any magic number across the board. It sort of depends on the category and how many SKUs are required and all that kind of stuff. Got it. All right. The next question that I had sort of come up over the week here was has to do with retail. So you're selling your widgets and you've got your Amazon FBA and it's all nice and tidy, but you're also starting kind of a wholesale arm, and you're starting to get some wholesale now. These giant retail companies are probably going to order in large quantities, but expect a pretty steep volume discount. But in terms of value, having that distribution channel budding or starting, what does that do to the valuation of the business? Does that play a large role, or is that something an investor kind of is looking to do themselves and would rather take control of that themselves, or is that are they more attracted to a business that's already have some inroads to some distribution channels on the retail side?
Yeah, there's a few ways to think about it. So first is having other channels is always better than having just one, broadly speaking. However, each channel is valued differently. And in the retail or wholesale example, so say you have a wholesaler that you're selling product to, it's what percentage of your overall annual revenue is it? That's the first question. And then what's the history on that? So if it's the first time they've bought and you don't know if they're going to buy again, you don't know what sort of refunds you're going to have, especially when it's retail. Retail terms are very retail friendly, not owner friendly, not business owner friendly. So the buyer to pay more for that, they'll need to see history of repeat purchase. They want to see the orders growing from that channel. And that channel alone needs to be more than 30% of your total revenue to move the needle on multiple to grow that.
Okay, got it. So just to touch on something that you brought up there is that although retail and wholesale, I guess retail specifically can be, large volume orders, but they're not business owner friendly, meaning that they need products on their shelves that sell. And if it doesn't sell, they're going to cut it. And they have the opportunity to send all of that dead stock back to you. Right.
It depends on the terms. But yeah, that's typically what we see. Yeah.
Got it. All right. Interesting. That's a bit of a scary thought. It's a bit of a risk there. It seems like
a little.
There's an opportunity, but but only if the products sell. And if they, if it's a bit of a gamble, say, well, I'm going to put them into retail and see what happens, it might not be in your favor. But, and so, okay, so my last question before we move on to the questions that you've had over the week here is a question that I think every caller that I speak to, every seller, every business owner that I speak to asks. And I don't even know if it's COVID specific to this pandemic time period or whatever, but I think people just ask it all the time. Is like, what's the appetite for e-commerce businesses right now? Is it more than it was last year, or is it about the same? Is it off the charts right now and you expect that to kind of die down? Are people just out, hunting for predatory, like trying to get low ball deals, or like what's the market right now? Is there a bigger appetite for e-commerce businesses than there has been in the past? And do you expect that to continue?
Yes to all of it. Yes, there's more buyers coming into the market with bigger budgets than we've seen in the last 3 months. There's more buyers, and we're talking about what buyers want every Wednesday. So we actually show you what we're getting requested from buyers. So larger budget buyers, there's more of them. Predatory offers, there's value investors right now. So whenever there's blood in the streets, whenever there's a downturn, recession, any change, any negative trend, you'll see value investors come out. This is where they make money. They believe strongly in the maxim that you make money when you buy, right? So there's always value investors, but especially when there's a change in the market like we're seeing right now, there's definitely more value investors than we've seen in the past. So yes, there is more value investors that will have more predatory type offers where you get a little bit of money and they say, we'll take the risk, or they'll say, we'll share the risk with you. What that actually means is we want to get the business for as little as possible, and you take the risk on whether we can actually keep selling this or not. It's kind of awesome as a buyer. As a seller, you may not be interested in something like that unless you really need to get out of the business. Then that might be your best offer or best option. But as far as legitimate buyers looking for good businesses of scale, we're still seeing a healthy demand. Buyers, I say this often, a good business will sell in any market. It might just take a little bit longer, right? But a good business with all the pillars that we talk about in all of our videos, what makes a good business will always be valuable. And even if you have to hang on to it, if it's kicking off cash flow, it's a highly profitable business, it's growing, you're not in a rush to sell anyway. So if you're in a rush to sell your business or you have to sell for some reason, yeah, it might be a little rough right now to sell the business. If you're not in a rush, you can just brush off those lowball offers, horrible terms, or negotiate, right? And once buyers see that you're not desperate to sell, we're definitely seeing more in line with what we've seen as good offers in the past already, based on what we're in market with right now.
Yeah, it kind of goes against logic sometimes for a lot of people when they see like a downturn in the market, and yet there's more activity somewhere else. And the only way that I can really think about it in my mind is that investors are always looking for a better return on their investment. And if it's not if it's not like the markets, like the Dow or the industrial or whatever, like, then they're going to put it somewhere else. So it's, and if that happens to be e-commerce, or if that happens to be something on the stock exchange, that's great. But yeah, they're always looking for a return on their investment. So yeah, if the market takes a downturn, then they're going to pull their money out of there and look for something else that has a better return. So yeah.
And the great thing for e-commerce right now is buyer behavior is changing. We're seeing more ground taken as far as online sales versus in-store sales. And I don't see that slowing down anytime soon. So if anything, e-commerce as an industry, as a category for acquisitions, will continue to rise in value. And that's what we've been trying to do since we started, is what's the upper limit of what buyers and investors will pay for e-commerce businesses. That's our mission. So this will be a good thing for a lot of our clients.
It'll be interesting to see what happens with Amazon in Canada, because many sellers that I talk to, I ask them what marketplaces they're active in, and most of them are going to say, yeah, we tried Canada, but it just didn't make sense. There wasn't enough activity for us to focus some resources there. But as you say, that consumer behavior is changing. And although Canada hasn't been, a hot market for online sellers, the population isn't what it is, obviously, in other countries. But it'll be interesting to see if that behavior changes and start to see more and more sellers sort of come into Canada, because the demand will be there.
Yeah, Australia is the same. It's just such a huge country, low population, vast distances between the population. It's always tough to deliver an online delivery service to a large geographical area with low population. The numbers just don't make sense, right?
I look at a $15 item on Amazon.com, shipped tomorrow, or I mean not right now, but shipped Prime or whatever. I look on Amazon.ca and I look at that same product, $75. And like a month together. Well, obviously, nobody's going to buy it at that price. So yeah, but it'd be interesting to see if more and more sellers will take a look at the Canadian marketplace, just to see if the demand starts to increase along with that behavior change. Yeah, it'd be interesting.
Absolutely. Years ago, I was looking at setting up an e-commerce business. We had one running already in the States, and I was looking at Australia. I was like, because I'm from Australia, I was like, well, what are the options here? We found a lot of demand for outdoor furniture, specifically wicker furniture. And I dug deeper into this niche, and the online buyers for these products were happily paying extra shipping. But at the prices we were looking at, around the $500 mark, you would pay almost as much in shipping as you would for the item. And then there was a serious supply chain issue on the delivery side. So I scrapped that approach. We didn't build that business.
Yeah, I would say not. Yeah, cool. Well, that's those were the three burning questions that I had a few times from people that I was speaking to this week. What do you got?
Cool. Awesome. Well, guys, and anyone watching here, if you do want to drop any questions in the comments, we'll get to those as well. But we do have a number of questions we've gathered already. So this one comes from Jamie in our community. He actually has 2 questions. Greedy bastard. Thanks, Jamie. Okay, so the first one is he took our advice. So both of these are relating to buying e-commerce businesses, which is one of my favorite topics. And he's read The Messy Marketplace, which we constantly talk about, and Jeff has on his desk, I believe. Yes. So this one, if you're thinking about buying businesses, not just e-commerce businesses, any business, definitely go read that book. And he's asked, that was a great book, but he's saying, is there anything else we'd recommend? Well, I have a couple books I would definitely recommend. I love in anything investing related, and specifically to buying businesses. So I'll go through a couple of other example books that you might want to check out. My personal favorite, and who I want to be when I grow up, is Ken Langone. He wrote a book called I Love Capitalism. He's, among many other business ventures, he's the co-founder of the Home Depot. So multi-billionaire, owns pieces of multiple multi-billion-dollar companies. And he talks about what he does, famously skips to work, just like Warren Buffett, loves what he does, works 7 days a week, hangs out with the people he does business with. His life sounds perfect, coming from a M&A background, investment banking background. So similar to us, he was doing deals and then got into the investing side and helping these companies raise capital. Super interesting story. The other book that I'd recommend is The Snowball. And this is as close as we'll get to an autobiography from Warren Buffett. He actually went out and found a writer that he really respected and essentially got her to go and do his life story. And he specifically said, whenever you're interviewing people about me and you get 2 differing opinions of me or a situation, go with the least flattering. And there's actually a story arc. I listen mostly on Audible to books. There is a story arc behind the story in this book where I feel the writer of this book, as she went through, became more and more and more of a fan of Warren Buffett as she went through the story. So, but anyway, it talks about a lot of his early deals, just deal making in general, how he thinks. I think it's one of the best books on just general investing, but also business advice that I've read. Do you have any books to add, Jeff? But while I just double check my Audible.
No, I don't think so. I was particularly on the buy side. No.
Yep.
I like, I sort of like a different brand. I've just started reading the Total Recall, which was your recommendation there. And another recommendation that I finished a little while ago was the Zappos guy.
The happiness book.
Think about delivering happiness. Delivering happiness. Yeah. And another book that I read recently was Built to Sell by another guy that you like to fanboy, John Warrillow. And but I mean those are more like on the seller's side. So particularly on the buy side, no, I don't know if I have any other recommendations. But I wrote those both down. A title like I Love Capitalism is definitely something I want to pull off the shelf for sure.
Yeah, it's amazing. I've listened to it a number of times. So definitely check those out. They're the main ones that I'd recommend because I like books that that have a good story element to them. I like learning via stories and that I've listened to more than once. So all of the books I recommend, I've listened to more than once and have caused change in my life. So, we have some questions. We'll get into these in a sec. Awesome. So I've listened to them all the months, and they've actually, reading the book, I've physically changed what I've done. So I've changed something in my own life after reading it or during reading it. One of those books was Wealth Can't Wait. That one was pretty cool by, I just passed it. I'm actually re-listening to this right now. What's the author's name? He's based out in Boston. David Osborne. I saw him speak last year, and he was by far my favorite speaker, despite me speaking there too. Okay, let's. I have one more question from Jamie, but let's take some of the questions from the audience here. So, okay, first up, would you be open to a buyer acquiring several compatible businesses, merging them and helping them sell the combined brand in 2 to 3 years, assuming the value is higher than the business on their own? Oh, this is a great question. I haven't had this one in a while. So correct me if I'm wrong. Sorry, your name's not coming up. We're in StreamYard here, but if you want to drop your name in the comments, I'll address you to your name. But thank you, sir, madam, for your, that was awkward. Thank you for your question. Leanne's saying wrap it up here. Okay, so would you be open to, so what they're asking here, and this is super common. People think, oh, look, if multiples are higher just because I have a larger business, more profit, why don't I just get together with my friends? Jeff, you and I and Katie and Fred, let's pull our businesses together and sell it for a higher multiple, right? If all you need to do is combine the businesses. Now, the first question I ask to someone, and I'll ask you, Jeff, because I don't think we've had this conversation. Jeff, have you ever disagreed on where to go to dinner with 3 or more friends?
Yes, of course.
Awesome. So what do you think it would be like negotiating a deal with one buyer and 3 parties involved? That's number one. What if the buyer only wanted 2 of them? This is a real scenario as well. So essentially, it's possible to do this. It is possible to do this. What you need to do is essentially make them one business. You need combined operations. You need combined supply chain. You want some cross-sell opportunity if possible. This business combined, even once it's centrally operated, unfortunately will not be worth as much or not get as much demand from buyers as if it was one brand that was that size. So everyone thinks, oh, just multiple arbitrage, get a bigger business, I'll get a better multiple, better outcome. In most cases, that's true, but it may not be the best result possible. I've talked to portfolio investors before where they have multiple brands and they're not correlated at all. And they're saying, well, how do we maximize the value? And it's like, well, you need some more synergy here. Yes, you have the infrastructure, the team to run it, but you really, that's one value driver. The biggest value driver you can have is a large business with one target niche market focus, one brand, one product, one category, not one product, one product category, right? So think of native deodorant versus 10 random e-commerce brands stitched together. Right, there's going to be more value
I think that's,
in that tight market.
I think that's what he's saying here. You know, acquiring several compatible businesses. So assuming that they mean that there is some kind of synergy there, that they do share a common target market, and merging them. I'm assuming that what they mean by that is centralizing leadership and having that corporate infrastructure under one business. And if you have that sort of one column and that does operate as one business for 2 to 3 years, then I think that it would definitely impact the value. So if I'm sort of reading into the words that they're using, I'm thinking that absolutely.
So this would, and again, if it was one single brand, that would be worth more. This is better than the first example I gave. I gave the first example because I get asked this quite a lot. But yes, you're right. In this case, they're saying several compatible brands. When you say compatible, I'd want them to be before, during, and after. I'd want them to be complementary. You want cross-sell opportunity. If you can prove cross-sell opportunity, so this would have to be outside of Amazon more than likely. If you can prove that customer buys all of your brands, or there's an escalation where they start moving around the brands, that would be even better. Because the more synergy there is, the more you can prove upsell, cross-sell, better margin through having these suite of brands, the better that would be. So yes, to answer your question, as it's written, yes. I just went on a long rant.
Yeah,
the answer is yes.
What do we
Was
call
it
that?
still
Long walk
valuable?
for a
I don't
short
know.
drink of water.
Yes. Okay.
All right. So here's another question here. So what do you guys see for valuation differences related to high volume, non-unique private label products, like a branded garlic press, compared to lower sales but unique products like a customized widget of some kind? So I know we've touched on this a little bit in some other units, speaking towards like defensibility and a real a focused target market. You know, being more valuable, but I guess it really depends on what volumes we're talking about here, does it not?
Yeah, it depends on the size of the business. We've actually seen, while we are seeing a bigger wave of buyers coming into the space, what we're seeing right now is IP being highly valued. So IP being intellectual property, anything unique to your brand, your business. So my thinking is, over time, like the branded garlic press example, I think that unless you have a really strong moat around your listings, that will give you some interest. But over the long term, I honestly think that the buyers even on Amazon are going to be preferring brands longer term. Right? If they see you out in the real world and they come and buy your product, I think that's going to play more than just ranking in the future. So future-proofing your business, I'd look to go more unique, more custom. How can you have, and you can use the customer reviews like everyone does to make their products better, but how can you go that extra mile? How can you get defensibility? Can you patent something? Can you bundle unique things in there? Bundling doesn't last that long, but as some examples, I think that's going to play into valuations. So the short answer to this is yes, there's a valuation delta or a gap between valuing these two assets. Everything else being equal, if they were both earning $1 million in earnings annually, the custom unique product, patented, completely unique product would potentially sell for a higher value than a more generic, I can go find this on Alibaba type deal.
Yeah, anybody can put their label on anything, but I mean, but yeah, in terms of like the real value of the company, the real value of your brand is how it's unique and how it is differentiated from the others on the market. If at the end of the day it's just a pair of scissors or just a garlic press, that could be wiped out tomorrow. Somebody else can just go to the same factory and put their label on it and throw more money at it and outsell you, and you're done. But if you've got a different handle, it's different material, it's bigger, it's longer, whatever, like if you've changed that somehow and sort of own that uniqueness, then that is going to have much more value long term. Absolutely.
Yeah, hands down.
Yeah.
And it looks like our first question was from Dennis. And he says, thanks for the answer. Thanks for the question, Dennis. Good to see
you.
The
reveal. Here it is.
Yeah, the big
we have a name. But you said that, Jamie, there was one more question that you wanted an answer from Jamie before we're running a little bit over time here, but we should probably get to that before we sign off here for the weekend. Yeah,
so I think his next question we could actually do a whole episode on, so I'll just keep it short. I know that sounds impossible, but here's what he asked. He asked, what's the first thing, so both of these are relating to the buy side, right? Buying an FBA business specifically. What's the first thing a buyer should do when they take over an FBA business? The answer to this is nothing. I'll say that again. Yeah, so when you first take over a business, any business, is do nothing. The thing you're wanting to do, you'll come in looking at a business and you'll go, I got 10,000 ways to make this better. Don't. Just learn what they're doing so you can replicate that and then stack on success after that. And as an entrepreneur, you just want to get behind the wheel. There's so many things I can improve. Awesome. Write them down in a priority order. Just get a handle on how to manage the business first, and then start with your highest leverage thing first, and do one thing at a time. Don't change a million things at once. On Truth About Exits, our podcast, I've interviewed dozens of business acquirers, and this is the one thing they all say, is when you take over the business, there's always a dip, because there's a knowledge gap between the previous owner and you. Even if it's poorly managed, badly marketed, there's something they're doing that is working. So make sure you understand and have a handle on what that is first before doing anything else.
So you want to have a whole episode on doing nothing? I think we can handle that. Who knew that doing nothing could be so difficult?
we're the Seinfeld of
there you go. What's the show about? Nothing. Awesome. Yeah, love it. No, cool. That's a great answer, because that goes against instinct. Yeah. And who knew that it would be so hard to actually do nothing? But that's interesting, to keep things as seamless as possible, right?
Absolutely. And that was a fun episode. But Jeff, how can people reach out to us?
Yep. sales@thefbabroker.com is by far and away the easiest way. It comes straight to my inbox. Tell me what you're thinking. If you're looking to sell, if you're looking to plan for an exit, if you want some advice on what you should be doing now, any of those things, send me an email and we'll arrange a time to have a call and learn a bit about what's going on. So that's it. sales@thefbabroker.com.
Awesome. And guys, again, if you have any additional questions, if you're watching this after the live, drop them in the comments of this video. We'll pick them up for next week. Just like Jamie did last week, he dropped the comments in. If you have an e-commerce business, an FBA business, you're looking to scale and sell in the next 6 to 24 months, come and join us at Double Your Exit Community as well. Our Facebook group, we've got a lot of cool content in there, and all of our videos on specific topics, everything you want to know before selling a business. And lastly, have a great weekend. And we'll see you on Monday. Thanks, Jeff.
Sounds good. Bye, everyone.